Hello and welcome back. Today we're talking about trading versus investing and really distinguishing between the two. And there are many people out there who don't actually understand the differences between the two. Many people use the terms interchangeably. Many people don't realize that they are two very, very different concepts. Now, trading, it just doesn't work. At best, it's a 50-50 coin toss. Sometimes you win, sometimes you lose, and it's hard work. The good news is investing is 100% fail-proof. It doesn't fail in the long term. Investing has never, ever, ever generated a loss over the long term. And that sounds pretty remarkable, right? I'm about to demonstrate how that is the case. It's a topic that's close to my heart, and it's a topic that I've often spent time explaining to people. And trading is just, it's easy, right? You go on YouTube, there are lots of courses on trading. It's very, very easy for people to teach what trading is about. Because after all you need are squiggly lines and a piece of software. There are no barriers to entry, right? You don't need any specialist knowledge. Anybody can pick it up. But if it was that easy to do, everybody would be making money, right? All the big institutional funds, all the big hedge funds would just be trading. But trust me, they don't, because they know it doesn't work, right? So please don't believe the hype. Please don't believe the videos that you might come across. Take it from me, investing is the way forward. So let's find out more. So I'm all about real investing. I love the concept of real investing because, for me, real investing is all about owning a piece of asset, a cash flowing piece of assets, which entitles you to dividends, to profits, and to future capital gains. But trading doesn't do that, right? And this is what trading is about. It's just charts, squiggly lines, things that sound great. I mean, the concept sounds compelling, right? Stop losses. Who wouldn't want to be stopping their losses, right? And that's a very, very common sort of term that educators use, that YouTube presenters use for why trading should be done. But it doesn't work. Again, if it was that easy, everybody would be making money without ever sort of incurring any losses. Okay, so this is what trading's about: squiggly lines, buy signals, sell signals, stop losses, moving averages, etc., etc. Now, don't get me wrong, I do use charts, moving averages, things like that selectively. It's one small piece of the puzzle for me. For me, investing is about actually owning assets. Now, before I talk about investing, if you want some evidence about why trading doesn't work, you just have to go to one of the trading platforms. Now, IG Index is IG.com is one of the biggest trading platforms out there. Now, the trading platforms by law have to now display a wealth warning. So if you just go to the homepage, you can see right at the top of the homepage is a wealth warning. And they have to display what percentage of their trading clients lose money. Now here in this example, it's 68%. Typically, it's around 70% of clients lose money, right? So the platforms themselves have to disclose what percentage of their clients are losing money. So that's evidence in itself, right? I've got lots more evidence, which I'm going to show you. But really, for me, investing is all about investing in the real companies around the world. 50 most valuable companies include Apple. These are all companies that we understand, we use, we're customers of, and we know that they have real power in the world. They have lots of production facilities around the world. They employ millions and millions of people, and they really do have a force for good in the world. So we're talking about Apple, we're talking about Visa, we're talking about car manufacturers, Tesla. It's not all about tech. We're talking about Shell, Procter and Gamble, etc., etc. Now, these companies generate real profits. As an investor, you are legally entitled to a piece of that company, a piece of their profits, a piece of their dividends. Okay, so we are in effect owners of these companies when we invest for the long term. When you're trading around, the ownership is almost a sort of distant concept. Okay, so just bear in mind, real investing is not a speculative activity. It's owning, having a stake in one of the or all of the biggest companies, the most valuable companies around the world. Okay, so that's important to know to start off with. Now, here's some more evidence about why trading doesn't work and investing does. And this is kind of mind-boggling. Okay, here are all the events for the last 15 years, any sort of event that had an impact on the markets. Okay, so you've got everything going back to 2009. You name it, we've got it. We've got worries about the economy, debt crisis, pandemics, wars, interest rates, inflation, China, Russia, etc., etc., etc. You name it, we've got it. Okay, and these are the headlines, right? You switch on the news, you open up a newspaper, you open up your social media feed. You'll hear about all of these. As soon as markets have a little wobble, the headlines are clear to see and to hear, right? You can see here the declines our markets have done. And if you're listening to this on the podcast, take it from me, there is a whole list of 27 different events over the last 15 years which have caused a market correction. Obviously, we'll remember all of those going back. You might look at this list of events and you might hear about these events and think, why on earth would I invest? All of these crazy events leading to market declines of 5, 10, 15, 20%. Why on earth would I invest in the markets? Well, as I mentioned, these are the headlines. This is what captures people's attention. Now let's look at the reality. We look at this on the chart, zoom out. Each of these red dots, and again, if you're listening to a podcast, we've just pulled up the longer term chart of the equity markets. And each of those events, which was just mentioned a minute ago, they just look like a small blip. Okay, they're barely noticeable on a longer term chart. And that's why trading doesn't work, because if you were caught in the middle of that panic and listening to the headlines, listening to people, listening to gurus who think they have an angle on the markets, what would you have done? You'd have sold. If you'd had stop losses, if you were trading around, you might have put stop losses for 5% lower, 10% lower. You would have been taken out of those markets. And actually, if you zoom out, if you look at each of those 27 events, they were the perfect buying opportunity. Every single one was a perfect buying opportunity to be sort of capitalizing on those losses and really pound cost averaging. So each of those 27 losses were actually 27 opportunities for you to be pound cost averaging into the markets. And that's exactly what I was doing all the way through this period and have continuously done since then. That's what Warren Buffett was doing. Okay. So all the serious investors out there would be capitalizing and to be pound cost averaging, drip feeding their money in, and to be buying instead of selling. If you were a trader, if you were trying to time the markets, you would have been selling or would have been forced to sell by your stop losses, which I really don't recommend. And actually, over this 15-year period, guess what? If you were holding on throughout, the market was up by 615% during this time period, which is pretty mind-boggling. A compounded average annual growth rate of 16.3%. Even higher if you were pound cost averaging it. Imagine if you'd been taken out, you'd have earned a fraction of this. If you were taken out by stop losses, if you were trading in and out, you'd have been taken out, essentially. Warren Buffett's favorite expression is to time in the markets, not timing the markets, okay, which is what gets you all the opportunities. So pretty mind-boggling, the chart to see each of those events on a chart, and you can just pull up any chart of the FTSE 100 or the S&P 500 or the global equity indices and just zoom out to see that markets, yes, they do sell off, but they always, always, always recover and make new highs. So always remember that. Okay, so investing is far better than trading. The quotes from Dave Ramsey always resonates with me. If you haven't heard of Dave Ramsey, he's a personal finance commentator in the US. Worth listening to. I don't always take what he says. I don't always agree with what he said, but this quote is something that did resonate with me. And it goes, money moves from those who do not manage it to those who do. This applies to kind of all manner of things in the investing world, whether you've got people managing your money for you, or in this context, regarding trading versus investing. Because when you are trading, you may not realize this. When you're trading, money is moving away from you to those who are investing. Okay? Again, another quote from Warren Buffett. The stock market is a mechanism to transfer money from those who are impatient to those who are patient, i.e., money moves from traders to investors. Okay? So do remember that. Here's another piece of evidence. And I'm always about evidence, right? So anything I'm always talking about, anything I'm presenting, I want to make sure that the concepts I'm talking about are backed up by evidence. Now, if you look at S&P 500 index, going back to 1928, you can see, and if you're listening on a podcast, this chart will be in the show notes. There has never been a permanent loss provided you're holding on for long enough. Okay, so on a one-day basis, it's a toss of a coin. A little bit better than a toss of a coin, but let's just call it a toss of a coin. 50-50 on a one-day basis, you'll either make money or you lose money. But the longer you hold that, the odds of you making positive returns are massively higher. Up to a point where if you're holding on for 15, 20, 30 years, the markets have never, ever, ever made a permanent loss. Now, that's pretty compelling, because if you can buy an asset that's never made a permanent loss, but actually over time has generated returns of between 8 to 12% per annum, that's a pretty compelling investment opportunity. And that's what shares are. That's what shares do over the long term. They've never made a permanent loss, and they've made inflation beating return. And it's not just about the US. It's, applies equally to the UK or any other part of the world when you're investing in shares. Okay. In fact, the UK, we get even older data going back to 1870. So that's 150 years. And, in the UK, exactly the same. We've had all sorts of events, going back to 1890s, the Bering crisis. We've had the Depression, the World Wars. We've had devaluation, Suez crisis, etc., stagflation in the 70s, all sorts of things. Markets always make new highs. They never stay down permanently. And when you're investing, you'll be gaining access to that long-term growth in the markets. When you're trading, you don't. Okay, when you're trading around, you're in 1 minute and you're out another minute, and you're going to miss out on the market gains that have always been there and always will be there. And one final piece of evidence. Let's take the world's oldest ETF, one of the Vanguard ones going back to 1976 in the US. And if you'd put in £50,000, and in just 2023, that £50,000 would have become 59,000. But if you'd invested over longer periods, over 3 years, it would have become £66,000. Over 5 years, almost 80,000. 10 years, £152,000. Okay, and on an all-time basis, if you'd invested 50,000 right from the start in 1976, guess what? Now you'd be worth £6.7 million. Just that £50,000 initial investment. Okay, and if you'd actually put in £100 per week from the start, you'd have made 6.6 million. So all of this, I'm just kind of illustrating the power of financial and time freedom. And you can achieve that through very, very simply investing, following the evidence, as we've tried to show today, pound cost averaging, and just following the process. Don't time the markets. Don't trade in and out. Don't use charts. Don't use stop losses. Just let time do its work. Let time do its magic. Let compounding do its magic. And you will, without really putting any effort into it, without really knowing it, you will reach financial and time freedom very, very quickly, particularly if you combine that with low costs and tax efficiencies, minimizing those leakages. Let compounding do its magic. Let investing do your magic for you. So hopefully that was useful. Today was all about investing and the magic and the power of investing rather than trading. And, really has two benefits. One is better returns. And secondly, which is even better, it is much, much easier. You don't need to be right or wrong. You don't need to be timing the markets. It's a very, very simple, passive process to compound your way to financial freedom. So hopefully that was useful, and I will see you next time.